Welcome to the Financial Advocacy Podcast. I'm your host, David Kinder, the tax-exempt wealth guy, registered financial consultant, and chartered life underwriter, and my co-hosts, Michael Moffat and Kurt Gibbs. This is a disclosure where we say you can't hold us accountable for any actions you take on your own, just like all financial entertainment shows. We are not providing legal, tax, or securities investment advice of any kind. We do provide general investment information for educational purposes only, and we will discuss alternative financial strategies that do not contain or include securities. You can view all of our disclosures and disclaimers at our website at www.financialadvocacypodcast.com. Look both ways for across the street. Let's get started. All right, Mike, we're at, week 11 of my 10-week financial literacy course here. I added a couple more modules just to see, well, they need to be talked about. And there's a different way to talk about this stuff. So this one, I actually just changed the title into the thumbprint or thumbnail, whatever the damn thing's called. So understanding the income tax system and the tax code, more or less. And we are not talking about this from the perspective of accounting. Not going to approach it as a tax advisor, not touching any of that. Mainly because I am definitely unqualified to speak about it in that way. Could have had, what's his name? I should have probably, but, have Brian come back on. He would have been a great one to talk a little bit more in detail on this, but I kind of want to just give an overview and have a little bit of fun with it because I got some television clips to share.
You always have the clips.
I've got the clips, and just because different things remind me of stuff, I'm like, yeah, we're going to do this. This is going to be fun. So there was, 30 years. I hate saying that. I just typed that in the other day for an old band teacher's post. So when I was your student 30 years ago, but anyway, 30 years ago, 29 years ago, I can say that I was involved in a network marketing company, not insurance related. And one of the best things that they got me to do was to read more books. And some of the books that I read were by Robert Kiyosaki. Have you read those books, Mike?
I have.
They're pretty good. Despite the notion that maybe Robert didn't have a poor dad, whatever. It doesn't matter. I've heard those things before. I don't care. Even if it's just a story, he's using it to weave a good story and narration so we remember it. Yeah,
the analogy works. I think that's the main thrust of it. It's more of an analogy than something that he was saying literally about himself, right? So
I think so. Yeah, this is not a biography. If it was, he could have titled it that. But he's written all kinds of books, and he's got this purple cover on almost all of them. That's his trademark of his book covers. And he's made a pretty good business model out of it. And in fact, we're going to be touching on the cash flow quadrant, the EBSI. We're going to use that as our model to talk about the U.S. tax code and the tax systems and what is it the government wants us to do and what do they not want us to do. It's a pretty good model. And whenever I try to do my best learning, I like model learning. Give me something that keeps everything simple for me to understand. And from there, I can take those principles and help guide my decisions. If it's too complex, could you imagine we could be here reading 70,000 page of tax code? No.
Well,
ain't gonna do it.
I'm getting off the podcast now. We'll see you later.
Yeah. You missed last week, so this is gonna make you pay for that one. No. Actually, what we had to do is we got to recruit Kurt to show up again, and we'll make him sit through it. Anyway. Going slightly off topic, but there are two tax codes.
We'll make him sit there and read the tax code for all the podcast he's missed.
Actually, we can hire him. We can have him read the U.S. tax code, and we'll post it on Audible. We'll see if anybody buys it. That's a terrible business. But anyway, I don't know if anybody's ever heard this before, but there are two tax codes. And they're the exact same tax codes for everybody, but there's two tax codes. And this is Judge Learned Hand. I assume that's how you say it, learned, not learned. But There are two tax systems, one for the informed and one for the uninformed. And both tax systems are legal because it's up to you as the consumer, you as the individual, you as the business owner, you as the sole proprietor practitioner, you as the investor. It's all up to you to understand, how does the tax code apply to you and your wealth building decisions or your spending decisions or anything else. And what was it that we said in the group is that an informed taxpayer will pay less taxes just because by default you have more of an awareness of what you're doing, and that awareness is very helpful for planning for your future. And in case Robert Kiyosaki's name ever looks familiar, I'm just going to throw that up there. Yes, he did co-write probably a couple of books with him, with the current president. I'm just saying that if you're wondering, what they might prefer, and the understanding the tax code, it's kind of helpful to see where they're coming from. So anyway, I just wanted to kind of share that. Now let's get into EBSI, or actually ESBI. That's kind of the order we'll take it. So on the left side is you working. And it can be a combination. You can have a job and have a side business of some kind. Very common. You can have a full-time job and you can drive for Uber. And technically, being an Uber driver, you are a contracted person, so you are in business under that contract agreement. But let's look at E, the employee. You have a job. The employee has the least amount of tax benefits. You are the consumer. And what is it that the U.S. government wants employee types to do? Well, there's generally three major tax breaks that the employee kind of gets. So I'm going to share my screen. I'll share it once I get the right thing up. And share my screen. And there it is. And I got so many things here to share. There it is. So there's three major tax breaks for those in the E quadrant. You have the child tax credit, which in 2025 is $1,700 per child. And that's a credit, dollar for dollar credit into your tax equation. You have your mortgage interest tax deduction. You'll notice that when you rent an apartment, rent a home, rent anything, there's no tax break. As a true employee, there's no tax deduction. But at least as a homeowner, you could deduct your homeowner's interest. And I'll get slightly technical, as long as you can itemize it, as long as all of your itemized deductions exceed the standard deduction. Standard deduction so high, it may not exceed it. So you have to determine, does that make sense if you're buying a home purely for the tax break, which you shouldn't. You don't really want to let the tax tail whack out. You want to make your decisions for your own reasons and then take advantage of every provision in the tax code, which brings up something else. There are no loopholes in the tax code. I hate that word. It implies you're trying to get away with something. The only time you're really trying to get away with something is if you're using what we call creative accounting. And anytime you're using creative accounting, that's when you're trying to fudge things. And I'm not saying you won't get away with it. I'm just saying if you're doing that, you're taking on the risk for an audit and the risk of being caught of trying to characterize something that maybe you shouldn't. But that's the only time when you're trying to get away with something. Otherwise, it's not a loophole. It's a provision. And the tax code has lots of provisions for those that are aware of them. So the third tax break is contributions to IRS qualified retirement plans, 401ks, and other plans like that. I can't think of any major tax breaks other than those. And what's interesting that during our working years, usually our taxes are much lower. But what happens over time, especially at retirement, the children are up and grown, but they're still going to ask you for money. So you don't get a deduction for that. The mortgage payments, assuming you have it refinanced, they're largely principal payments. So you're paying dollar for dollar mostly into paying the principal on the loan. So you only get the deduction on the interest. If you don't have interest being paid, you're not getting a deduction anymore for those payments, or at least it's very minimal. And then you're pulling money out of your IRS qualified retirement plans, not putting money in. And when you're pulling money out, it is fully taxable as income. They are salary deferral plans. That's literally what it says in IRS publication. I think it's 560. Salary deferral plan. So, if you're earning 100,000, you defer 20,000, you're going to be paying your taxes on 80. That 20,000 is deferred to sometime in the future. You're putting it in the plan to watch it grow. And then when you finally pull it back out, you're paying taxes as of the tax code design in that year, whatever it may be. That's the main ones. I can't think of anything else that's really that big. Medical expenses above 7.5% of your AGI, adjusted gross income. I apologize for using the acronym. But I hope that no one has that issue, because that means you've got some big medical issues. And that's what insurance is for. And we hope that people are properly covered. And we're not going to cover especially lately, the political landscape regarding health insurance. We're not going there. But yeah, that's kind of it for employees. We don't get a whole lot. Now, I think it was Bush 1, Bush Sr. I think he was the one that ended being able to deduct interest on credit cards and other consumer loans. At that time, you're able to deduct those things. Those things are not deductible anymore. Under Trump, Trump ended being able to deduct your interest on home equity loans and lines of credit. So I think that one's kind of interesting that one ended. However, he more than doubled the standard deduction. So he made up for it in a different way for everybody. So there was a give and take there. But really, for employees are the consumers. And we're trying to incentivize, if at all possible, major purchases like buying a home. So whenever I think on this topic, I think of The Cosby Show. You're going to love this. Watch this.
Shouldn't care if you get D's because you don't need good grades to be regular people.
Right.
Okay. Oh, suppose you graduate from high school. Let's say you just slide by. All right. Now you got to find a job. Now, what kind of salary do you expect for a regular person?
$250 a week.
$250 a week?
Yeah.
Sit down. I'm going to give you $300 a week. Yes, indeed. $300 a week, $1,200 a month. All right?
Great, I'll take it.
Yes, you will. And I will take $350 for taxes.
Whoa.
Huh? Yeah. Now, because, see, the government comes for the regular people first.
So that is every time I'm thinking about taxes, that's what comes to mind. The government comes for you first because and here's the way that it works. They require employers to withhold money out of your paycheck. It's that quickly and that simple. So yeah, whenever I hear that, I'm like, yeah, that's the employee quadrant right there. I think I got that one pretty good there. Rael, salute to you. Glad you're here. I think that kind of covers it. I think I missed anything obvious there, Mike? We didn't touch base beforehand.
Nothing that the average person would necessarily be looking at, right? I mean, that's your average employee. Those are the kind of standard things that you look at for deductions and things like that, So yeah, there might be some other smaller things out there, but they're more one-off situations, like you mentioned with the health, with the healthcare thing. So yeah, I think overall that covers it pretty well.
Okay, so let's go back to our model here of the ESBI. So the next part is, and whether people choose to move on to other squares or other quadrants, that's up to you. But let's look at the S quadrant. You own a job. You are self-employed. These are practitioners. I think of doctors, medical practices. I think of lawyers. Think of architects, insurance agents, investment advisors. These are people that are in professional occupations typically, or let's take a retail storefront. Someone who is the general manager. They are running the store. They are running the warehouse. If they are there, they own that job. They've got a job that needs to be done. The major difference between this area, the S quadrant, and the B quadrant, because the B quadrant is also being a business owner. The difference is the S practitioner or store, practitioner, franchise, whatever it is, can't run without the owner, at least not for an extended period of time. It is dependent on them. Either they are the primary source of the value of that enterprise, or they just have to make sure that things get done that need to be done. And if they're gone for a week, the whole place might as well shut down for a week. Imagine a dentist, and there's only one dentist in that office. Unless unless there's more dentists in that office or dental assistants can do the job, you can't do anything. So, it's highly dependent on you being there. Now, being in practice or being in business that way, you still get all the tax breaks available for a business owner. So the tax breaks between the B and the S, they're the same. They're just at a different level, different quadrants, different ways that they're applied. It's just a little bit different. But the way that the business functions cannot function without the business owner being there. I got an article on that some more, and I think that's pretty much it. But yeah, now self-employed, they could certainly have support staff. I highly hope that they do, because you can't do everything all the time. They might have some technology at work. Hopefully. Technology is far cheaper than hiring people. But otherwise, if they don't go to work, they don't earn anything. And even then, even if they go to work, there's no guarantee they will earn anything, right? We're in the insurance business. We know that it's possible that you could go work and try to cultivate relationships and such, and sometimes people don't buy, which means that time is technically wasted unless we look at the better way of looking at things in life and say, well, that's a learning experience, which is the way that you kind of save face with yourself. Salute to you, Alonzo. Glad you're here, my friend.
What's up, Alonzo?
So that's kind of the way that the S quadrant is described. You are in business, but it revolves pretty much all around you. If you don't show up, no one gets paid, no revenue is generated at all. Keep in mind that you are taking on risks. And one of the things that the tax code tends to reward is risk taking. And that's something to kind of keep in mind. So when we're looking at the S quadrant or the B quadrant, keep in mind that to get these businesses and practices off the ground, there's capital that needs to be spent first, which means all that capital that's being spent on tools, supplies, building, infrastructure, whatever it is, all those things are tax deductible for business purposes for the intention of creating a profit. Correct. Now, you don't have to have a profit yet. I don't know exactly what the guideline is, but if you don't earn a profit after so long, then the IRS will classify your business as a hobby, and then you lose all your deductions going forward. So you do need to, at some point, show a profit, or at least show that you're serious about what you're doing. If you have a business of restoring cars, but you don't sell any cars, you do not have a business selling cars. It's just not going to work. But the tax code rewards risk takers. So let's take a look real quick at, I already showed his face on the other book cover. Let's go to the first run of his presidential campaign and that debate between him and Secretary Clinton. And Secretary Clinton says, you don't pay your taxes. Now, Trump was one of the most prolific people in the world. Let's just put it out there. If Trump was really committing tax evasion, he's not hard to find. The IRS, whoever that would be in charge of that, they would have been all over that. Don't you think they would have loved that press, to be able to say the government's finally cracking down on millionaires and billionaires. We're going to make sure they pay their taxes. So the thing is that she basically made the accusation of tax evasion. But Trump came back and he said, what? That makes me smart. And he said that because he's coming from the place of tax avoidance. If you can avoid incurring a tax, or you have other deductions that offset a taxable event, that is legal in the tax code, which goes right back to Judge Lernahan's quote that you can deduct. Actually, did I share that one? I think I did. No, I shared the two. I shared the two. What's it called? Things. So let me share this one real quick. Let me remove that one. Add this one. The legal right of a taxpayer to decrease what amount. Let me zoom in. The legal right of a taxpayer to decrease the amount of what otherwise would be as taxes, or altogether avoid them, by means which the law permits, cannot be doubted. And that's Judge George Sutherland. I think he was an assistant to the Supreme Court. So he was high up when he made that quote there. So you are allowed to use the tax code, manipulate it to your advantage, as long as you're manipulating it by means which the law permits. It is not a requirement that you overpay what you're required to pay. That's not anywhere. Now, the government will take your money if you want to make a contribution. I don't think it's deductible, though. I don't see what would be the point. It's interesting that, typically speaking, most people like to vote for other people to pay more money because they think they have it. They should be paying it, but not for themselves. Now, I'm here in California. Mike, you're there in Illinois. We are in two very blue states. And I think according to Truth in Accounting, we're ranked somewhere near the bottom. I looked it up ours the other day. California is number 46. I think Illinois is just maybe 47, 48. I'm not sure. But
we're right there with you, buddy.
We're right there. And the thing is that when you talk to anybody individually, they might say for society at large, everybody who has more should be paying more. But you ask them about their own. And that's when the truth comes out. Like, oh, well, I paid way too much. Oh, well, would you like to fix that? We can help you fix that by means which the law permits. So let's look at businesses. Businesses do get tax breaks. Let's look at this again. Now, according to the book, and I know where the book was going with it, and I got to admit, Robert Kiyosaki is pretty good at marketing. He leveraged the network marketing organizations because, quite frankly, he was in the business, obviously, other than his real estate business, which real estate is a wonderful tax advantaged business that has all kinds of tax breaks in it. But he was trying to sell books. And if you want to sell books, and you want people that have a culture of wanting to read books and share books and distribute them, go to the network marketers, right? So he called businesses, you own a system and you have people to work for you. Well, and then, the network marketers say, we've got a system. No. You are their system. There's a big difference there. You always got to look, whose system are you really working for? When I've trained agents regarding prospecting, I tell them that, when you look at the Project 200 thing, which is you write down names of 200 friends and family and everybody that's part of their prospecting because you are now a free source of leads for their returns. They are not helping you build a business that will help you to be continually sustained. They're helping you to get immediate sales so that everybody else looks good. But the way I look at this is that it is not a system. It is a system of systems, and you have people working in those systems, and those people are working for the business, not 1099 contracted people. You want people that are really building a business, you hire them, not contract them. So we look at someone like Jeff Bezos, and I've actually got a great clip of him, and I'll share that in a second here. But Jeff Bezos, what is it that he's been doing to allow Amazon to pay very little taxes? And I'm not talking about him personally. I got that clip somewhere else. Because personally, he will borrow against his own stock to get a loan and use it for whatever he wants, and then pay back the loan when he wants. That's how he can have lower taxes individually. By the way, everybody else can do that if you have stock that you can borrow against in an account that will let you borrow against it. So everybody can do it. The question is how big can you do it with? Elon Musk did the same thing when he bought Twitter, right? He borrowed against Tesla stock. to buy Twitter. Very tax advantage. That makes them smart. But this was Jeff Bezos on The Tonight Show in 1999. This was just great. Here.
I understand. The company is worth billions.
Yes.
And every time I pick up the paper, each year it loses more money than it lost the year before. The company's never made a profit.
That's right.
Now, why? How does it? Why? How does that? Why?
Seems like a new math, doesn't it?
It does. I mean, it's to someone who doesn't know anything about this. It's amazing. You know, we lost $12 million last year, and we're doing great.
Well, there are a whole series of Doonesbury cartoons about this. This is not a new phenomenon. We are a famously unprofitable company,
right.
And we are investing in the future. It's not, which isn't unusual. Companies have done this before. What's a little surprising about Amazon.com is the scale to which we're doing it. We're doing it in a big way.
I see. So you just keep reinvesting.
We're reinvesting.
Now,
and so they're doing a lot of investing into research, investing in technology, investing in robotics and all their infrastructure stuff, research and development, experimenting with new markets and things. There's all kinds of things. And that is all tax deductible expenses. They're allowed to do it. And we need them to do it. Because if they don't do it, who's gonna? Well, the government probably will through universities for certain research. But that's maybe a little bit more on the scientific side. I don't know. Give Elon a try. Maybe he'll come up with something different.
That sounds like a Doge project.
Yeah, that could be. Who knows? But Doge right now has been cracking the whip in terms of current expenses, not necessarily new investment. And because I don't think the government can deduct against itself. It doesn't make sense. The government is the government. They can't deduct anything. I mean, against who? Wouldn't make sense. But one of the criticisms that often happens is that people who don't fully understand how, and they call it trickle-down economics, right? Because we want businesses to come into an area to create a ton of jobs. Mm-hmm. And by doing so, businesses get to deduct those salaries and bonuses and compensation and benefits and all those things because that is a cost of doing business. It's under the Internal Revenue Code, Section 162. And then all those other people, those thousands of people that have been hired by these companies, they are now paying taxes and ideally, collectively, higher than the tax breaks that the business got for coming in.
Right.
So
and that's,
here's another little, yeah.
Right. And that's a big reason why a lot of times you'll see states or cities or counties or whatever it is give tax breaks to businesses because they want the employees working. They want the tax revenue. They want people spending money there so they can collect tax revenue on different goods or alcohol, tobacco, whatever it is, so
the vices. Yeah. Well, people spend money on those vices, especially if they're on public assistance. So I don't think they
ruled. Well, fair enough. You know what I mean? That's why a lot of these businesses, get these big tax incentives from local and state governments is because they want the business there so they can get the tax money out of all the employees that move or that are in that area that have a job working. So, a lot of times I think I get the sense that people get upset that these businesses or business owners get all these tax breaks. But at the same time, well, if you don't necessarily allow them to have those, they'll just pick up and move somewhere else that gives them to them. So,
exactly.
You have to give the balance there, and tax money has to come from somewhere. So
here's another clip that's describing exactly that. This is Roseanne from the Roseanne Show 30 years ago.
Hi, I'm Mike Summers, your state representative. How you doing?
Great.
Good. I'm going door to door trying to get to know my constituents.
Oh, door to door, huh? That takes a lot of time. Why don't you just go down to the unemployment office and see everybody at once?
I hear you. And you're right. We can't let this area's workforce lay idle. That's why bringing in new business is my #1 priority.
How?
Through tax incentives. See, we're going to make it cheaper for out-of-state businesses to set up shop right here in Lanford.
So they get a tax break?
Yeah, that's why they come here.
Well, who's going to pay the taxes that they ain't paying?
Well, you will, but you'll be working. Good, steady employment.
Union wages?
Well, now, part of the reason these companies are finding it so expensive to operate in other locations.
So they're going to dump the union so they can come here and hire us at scab wages, and then for that privilege, we get to pay their taxes.
Is your husband home?
Anyway, it explains the point. That's just on the negative side, but that's always fun to kind of explore. So, but yeah, you got to bring the people in, and better to have someone pay.
Yeah, somebody's got to pay the tax, right? So it's either going to be somewhat the employees or the business. And for the employees, there's usually a lot more employees, right? So, you at least spread it around that way. But it does suck because somebody has to pay the taxes one way or the other. Like I said, if you're going to heavily tax a business, they'll just take their good product, whatever it is, pick it up and move it somewhere else that won't tax them. So, unfortunately, it does tend to trickle down to the consumer or the employee. But, I mean, it's got to come from somewhere.
Exactly. And so there is a cost of trying to be more economically stimulated, for the better term. But I remember seeing, especially during the pandemic, when Amazon would be in bidding wars between different states, different cities, and such. Who's going to give them the best deal to have Amazon build a huge warehouse or something? In fact, I think they've got one going on here for Ontario, California. Here, it's supposed to be the world's largest. I think it's 4.1 million square feet. So it's going to be a massive thing, and I don't know exactly what they offered to get them there. About 25 years ago, he used a different company, but Fry's Electronics was a big box electronics store, and I worked for them a long time ago in the city of Oxnard, and I remember that there was some news about how they offer them to either waive certain fees or something in order to have them set up shop there. And that location, I think, was a 100,000 square foot store. I mean, just a big. I mean, they sold everything. If you're not familiar with Fry's, it was a massive store. When I worked for them, I sold computers. But just a huge store. And of course, they wanted to attract that business into that area.
It's
and
just
what
like
do? You've got to make it attractive for them.
It's just like a Best Buy or Circuit City, if people remember Circuit City.
Yeah, exactly. Except about twice the size or bigger.
Right.
Just massive.
Or here's another one for you. Comp USA.
Oh, wow, that's old. But true. Fry's model, because I worked for them, I remember this. I think I remember the company training video. Anything they could plug in, they wanted to sell. Or anything that had batteries, they wanted to be able to sell. So they had all kinds of things. And they were really good for building your own computers. Of course, you got to make sure everything matched up right and stuff for drivers and everything. That was interesting. I was talking about this at my community band rehearsal last night. So it's fresh on my mind now. But anyway, when you want to attract bigger employers to an area, they are the person that has the supply. So how do you create demand? You've got to attract them in some way, shape, or form. And city governments and county governments should understand that the person who's paying the taxes, if you want to increase tax revenues, maybe you need to increase the tax base, have more people paying a little bit more than having one person paying a ton. So it's just understanding that that's how the tax economics works. Now, going back to here, again, the business owner, they have systems of systems. If you guys have heard me talk about this, I like the Restaurant Impossible, Kitchen Nightmares, 24 Hours to Hell and Back, Hotel Impossible. I've heard all of these coaches and consultants, Anthony Melchiori, Chef Robert Irvine, Gordon Ramsay, they've often said the same things, which is that you've got to have the right systems and the right people in place. And that's how you make sure that your business can be successful. And when we meet next week, we'll talk about some of the fundamentals of some business planning and business protection things. But for right now, we're just going to keep it at that. It's about people and processes in place that generate a given result. Okay, I think I beat that to death. But let's look at I. Being an I is being an investor. And I really need to delineate this kind of investing versus a 401k. A 401k is a savings plan that happens to include securities. It's savings plans with risk. I heard that once from Kim Butler. In fact, Kim Butler was one of the Robert Kiyosaki's personal planners. And actually, there was a time I actually had her personal interview with him and such. But in her book, she talks about 401k plans, IRAs. They are savings plans with risk. That's not being the I quadrant investor. The I quadrant investor is someone who is investing in other people's ideas. Think Shark Tank. Think someone who's hearing business proposals. Think of someone who, and you can actually combine your BNI. I mean, if you're looking at BNI, sorry. That was terrible. I'm thinking body mass index, and I'm thinking about the BNI networking group. No, that was bad. But anyway, no, but if your business is developing rental real estate or flipping real estate, that is now your business. If you flip a house in the same year, that's a ordinary income treatment. And you've put your money to work, you put yourself to work to fix up the house to make it ready to sell, and you've sold it in the same year, that is your business. But if you want to be more of an investor, you're going to buy and hold it. You're going to fix up that property, you're going to rent out that property and get that they call it passive income, even though you're in the business of providing rental units, whether it's business or personal, commercial units or residential rental units, whatever it's going to be. And that's one of the best combinations, by the way, at least for, I can't say average anymore. I want to be able to say average. But if you build up yourself up well enough to where you want to do that kind of business, that's being a true investor. You're investing in other people's businesses. And we're not talking about securities. And the securities is, in a way, it's the most sanitized version of the way that you can invest.
Yeah, Shark Tank is a great example that pretty much everybody knows, for this quadrant, right? So you find a business, you like the business, like, Shark Tank, business owner goes and presents the business. Mark Cuban invests $1 million and he's an investor in that business, right? So that's kind of the idea. Now you own a percentage of that business. And of course, the idea is to recoup that money, however many fold, and then keep doing that. That's more of what the investor quadrant is talking about, where you're actively investing in other people's business, and you may have to be involved to some degree, right? But in theory, it's going to generate a passive income that you're going to get a return on your money on.
Mm-hmm. And you're going to have far more knowledge of how the inner workings of that company are. You're definitely going to have access to the decision makers because you're a shareholder in most cases. But there's also the way to invest in a company, which is to be a lender to that company. And obviously, banks are lenders, but then usually before businesses get to a bank for borrowing, they sometimes borrow from family and friends and such. And that's usually on the "Do you love me?" Kind of a promise. And if you love me, help me start this up.
And that goes back to Shark Tank too. My mom gave me a $10,000 loan to start my lemonade stand, and here I am on Shark Tank, right?
There it is. Yep. Yeah, there's a graduation thing. You first off with your own money and your own credit, then you move on to other people's money that you personally know, and they just give it to you because you're family and friends or something. Then you're going into more institutional borrowing and things like that. But it could be not just be ownership in your company, it could be lending. So Mr. Wonderful, Kevin O'Leary, he'll sometimes propose, you know what? I want a royalty on it, but I will lend you this money. You'll pay it back at this percentage rate. And this way it's a loan, not equity interest. And he just wants a royalty on it. So that's different than having ownership. So it's all depending on the agreements, all done privately. This is not something you're going to read about in the newspaper until after it happens. So that's being a real investor in that quadrant. This is not, let's set up an investment account and let's go ahead and buy Amazon and Exxon and whatever other stock. No, those are savings accounts with risk, and it's not nearly the same thing. And when you are an I investor, you have certain tax advantages. They're about the same as every other kind of investing, but you do have those advantages. It's just better to be able to do it be able to see everything, full disclosure, full transparency that you probably might not get with securities. There's all kinds of things that manipulate the markets, and we don't usually know about it until after they crash. But there's another level of investment, which is being an accredited investor, or it's either sophisticated or accredited investor, and those are SEC defined terms. So even when you read in the book, Rich Dad, Poor Dad's cash flow quadrant, there comes a point where Robert's coming in to see Rich Dad and his best friend Mike, I think Mike was his name, and they're talking about making an investment, and they say, they talk to Robert about it, the way that the book outlines it, and Robert says, "I want in. Can I put in $3,000?" And the response is funny. It's, well, you can't. It's not allowed. It's illegal. And the reason it's illegal, it's not because it's an illegal venture. It's because that Robert is not a sophisticated or accredited investor. And when that happens, there's probably ways that they could fold it into their own money, but it's not supposed to be done that way. So again, those are just special offerings for people who can handle it. And in order to be at that level, you have to have income at a certain level, and you have to have assets at a certain level. And from what I understand, if you've ever had securities licenses in the past, I think they've grandfathered everybody that's ever had securities licenses that you can now be an accredited investor. Do not quote me on that. I just remember reading that somewhere. They either proposed that or they did make that change. I'm not sure, which would be nice, for me, because I'm not at that point yet. But wouldn't it be nice just to be grandfathered in to say, look, if I've got 50 grand, throw it into that private offering and I get to do it legally? Who knows? Alonzo asks, so would self-employed be insurance only, business owner be an RIA, and investor be AUA? I assume assets under administration. No, I'm looking at RIA and insurance. You're still in the S quadrant. You own the job. That the only thing that's different there is that you've diversified your offerings. You're still doing the same job. The difference is that you're doing different things. You've expanded, hopefully, to the better of those offerings. An investor being AUA, I'm not sure what you mean by AUA, because I've heard of AUM, but that's being an RIA with assets under administration. AUA to me sounds like assets under administration, and that's a different topic that for me falls under private placement life insurance, which is totally not what we're talking about today. He says yes to the accredited investors grandfathering in. Okay, so Alonzo's been studying this stuff. He's current in because he's studying for these licenses. So good. I'm glad to hear that, or to at least have that reconfirmed. I could have asked AI, but it just came to my mind just now. So, but yeah, just being the investor, this isn't being a professional. Being meaning that you're serving the public, you're holding out a shingle that says I am providing the services to the public. That's not what that's being in the S quadrant. By the way, in being in our business, if you are in the S quadrant, you want to move to the B quadrant, you're actually moving yourself out of being a practitioner, and instead you're in the business of developing advisors and agents, and you are not taking on new clients yourself. You are building a firm. You're building a practice that can basically run without you. You're trying to enhance the value proposition of that. I know that Michael Kitces actually has a blog article and or YouTube video talking about the reluctant business owner, where the financial planner became a business owner. They didn't really want to, but they had to do it for the way that their practice was growing. So sometimes you might come to a point in growing your self-employment positions like, well, do I want to keep it growing? And if so, what's that going to take? What are the costs involved to be going into that B quadrant? And is that what you really want to do? And if you really don't want to do it, then you just accept that you're now in the lifestyle business. You are choosing a lifestyle way of living as opposed to trying to build the biggest, massive thing that you possibly can. And that's okay, because sometimes some things are more important than money. And for me, I like the idea of less stress. So I also like the idea of less liability. I do not necessarily want to recruit. I've been advised against it because it just seems to be a trap on its own. I do not want to, for lack of a better term, babysit.
Yeah, it's a nightmare, man. Recruiting is a nightmare.
So yeah, if I'm going to be building a business, it will be people that I hire or that I have a direct contract with, and it would be very selective. I would have staffing.
Hey, if you recruit and you're successful at it and you do well, good for you. I applaud you. I do not have the patience to put up with that. It just I can't deal with that. Yeah. But hey, if you can do it, good for you. It's a great way that you know you can make passive income.
Yeah, and we know that a lot of those organizations that are out there, and they primarily seem to focus on the lower end of the product lines because there's less liability. It's easier to place. There's far more people to sell them to. So that's just kind of how that works. But I mean, I have it in my Primerica series, if we want to call it that. In one of them, I talk about, well, all you have to do is go up level a little bit in your marketing, just a little bit. And instead of trying to sell 100 policies a year of $1,000 of premium, which would be what, $100,000 of premium sold, instead of trying to do that yourself or trying to get 100 people to sell one policy at $1,000 a year, which might be the Primerica model, and you try to earn 10% on that, that's 10 grand to try to get 100 people to do that just once a year. I would rather go up a little bit and help someone place maybe $500,000 into an annuity and make 30 grand. Okay. I mean, it just makes far more sense, far less liability, because I could be responsible for my own stuff. I'm only responsible for everybody else. But yet, if something goes wrong, it trickles up line, and that means I have to pay back whatever I had earned on that. And I don't want to.
Yeah, that's a dirty
so
little secret of the insurance industry is that if you have a downline and your downline gets a few chargebacks and then quits, which a chargeback is where somebody signs up for a policy and then they end up not paying. Typically how it works is you get advanced 9 months of commission, right? So if the policyholder cancels within the first 9 months, you're going to get charged back that advanced commission that the insurance company pays you. So if you hire a bunch of people and they all sell a bunch of insurance for 2 or 3 months and then they all quit and all their policyholders cancel the policies, you know, you have 5-6 months worth of unpaid commissions that get charged back up to you as debt.
Yep.
So it can be a big problem.
It certainly can be. So that's obviously we're talking about this because we're in the industry. We understand how some of those things work. And so when you're looking at jumping around to different quadrants, it's important to count costs. What are our liabilities? What are the things that we're liable for? What are the things that other people can make us liable for? There's a whole lot of that stuff that goes into it, which is why the tax code does reward risk takers, but you better know and quantify what are the risks you're taking. And in fact, thinking about this because most people do not understand the plights of business owners. They often think, wow, they are so successful, they don't have to worry about anything. And that's usually a very surface level view. These are the concerns of business owners. They're concerned about profitability, revenues, right? They got to make, now profit is what you get to keep after you've generated the income. So a lot of that is expenses, keeping costs contained. What about credit? Being able to expand your ability to borrow so that you can expand or be able to borrow funds in case of a business contraction. Things get low a little bit. You know what? You got to make sure you can still stay afloat. How are operations? Right? Can you improve operations and be more competitive based on your costs? I mean, I think everybody's ever worked in fast food at some time or another. And one of the ways that fast food companies make their money, strangely enough, is by cost control. They're very careful on how much sauce they hand out. Unless you work at Taco Bell, they give you a handful. But you ask anybody else for sauce, and they're like, "Here's 2." Oh no, I want 4. Well,
now
25 cents
a lot of
each.
these, yeah, right, exactly. I was just going to say a lot of these places now charge you for the sauce.
Exactly. And if you want napkins, you have to ask for them. They don't leave them out there in the dining room area. And some might just start charging you for drink refills. So there's a lot of things that businesses are trying to do to try to contain or reduce their losses on costs. They're concerned about cash needs to make sure that they keep their costs of operating payrolls and paying vendors, keeping the bankers paid. Competition costs and competition issues. I remember seeing it was one of the early episodes of Kitchen Nightmares, and I think it was called not the Olive Garden, but it was called The Garden. So and someplace like in upstate New York or New Jersey or something. And they didn't realize that one place, when they first opened up, there was only like 5 or 6 restaurants in their area. Over like 10 years, there was 40. So no wonder their business was going down, even if they were at the top of their game, which they weren't. But even if they were, there's 40 other places. How do you compete for their attention and compete for those dollars? So just because you're in business doesn't mean you're on easy street. In fact, if anything, you've got to make sure that your business is a viable going concern. Service. I mean,
Right.
especially today in today's social media environment. Here, I'm going to take this down.
Oh yeah, well, even not with social media, right? I mean, having a social media presence is important, but even just the internet. When the internet came along itself, all of the reviews and the easy access that people have to be able to learn about your business, if it's any good, and then not only just your business, but all the competitors around you too. So you really have to watch yourself and be on top of your game to continue to promote and earn more customers.
Yeah, exactly. But now we've got these things, like websites like Yelp. You want something to go viral, you put a bad review on Yelp and everybody's going to read about that.
What's the other one? Location. Angie's List or whatever?
And although I think you have to pay to be on Angie's List, so that's at least a little bit more contained there. But you got the Reddits, you got obviously Facebook, Twitter, Instagram, and everything could go viral.
Better Business Bureau.
Well, Better Business Bureau is a scam in and of itself because you don't need to be a member of it.
Well, we're not going to go down that road.
Yeah. Alonzo, I agree with your thing because when I was training people, I told employees, because I used to be a trainer at Boston Market and such, and I used to say, look, if you add that little extra mashed potatoes, that's your raise. You got to give them the proper proportions. And when someone says, oh, you could put a little bit more on there. Well, an extra side is, at the time, $1.35. Today it'd be like $3. Yes, I memorized those prices back then. A little scary. So you're worried about competition, worried about service. We're worried about personnel issues. If you've ever thought about HR complaints and stuff and anything that gets out of control there, and what could those lawsuits add up to being? So that's what, remember, HR, it's not always for the employee. That's part of it, but it's really protect the company to make sure that there's no lawsuits. That's what they're really trying to do. Labor issues, and we're talking about either collective laboring bargains, that's unions, or just by making sure you have enough labor to take care of it, or maybe you've overhired. That's a possibility too. What are the general economic conditions? What are interest rates doing? How do interest rates increasing affect your business? How do interest rates decreasing affect your business? Public relations and business ethics, making sure that your business is seen as a viable community player. Are you contributing to something that helps make a difference? That's one of those ways of building goodwill. So, if you're involved with the American Cancer Association, or you're something for like a breast cancer, those things are, I call them easy, but they're easy to be able to say we're contributing back to something, because that's an important part. Government, when government changes things, you get a change of administration like we're getting this year. What's it going to do to change everything? Now, the last administration really loved electric vehicles, and they wanted to get rid of gasoline-powered cars. Well, this administration, they just want all the cars built here. So we'll see how well all of that works out. But there's dynamic markets and technology. Everything changes. The way business was done 40 years ago is not the way business is being done today. Back then, you probably could have put an ad in the Yellow Pages. And if you don't know what the Yellow Pages are, that's how different everything has changed.
Oh,
if you don't have a website, are you in business?
I used to have an ad in the Yellow Pages for my way back in the day. Oh gosh, this is scary. Probably over 20 years ago now. I actually owned a carpet cleaning business, and I had, an ad, and it was expensive, man. It was expensive to advertise in the Yellow Pages. It was not, especially if you wanted, any kind of like a square instead of just having your name listed in there. If you wanted your picture, man, that stuff was hundreds and hundreds or thousands of dollars, and this was 20 years ago. So I can't, if the Yellow Pages, I can't even imagine what it would be today, but.
I haven't seen the Yellow Pages in forever, but yeah, you get a big display ad and you say, mention this code for this coupon for savings, or you get one free room. I can only imagine what your ad said. But 40 years ago, that's where you had your advertising. Now, if you don't have a social media presence, which actually helps. See, the Yellow Pages is great for geographic advertising. Whereas, you get onto Facebook. Facebook has so much data. Scary or not, most people are probably more scared of it, but I know I could pinpoint an exact demographic of who I'd want to target an ad to. By the way, the more you pinpoint, the less response you'll probably get. So it depends on what your objective is. But you have dynamic markets of technology. Tax laws are always in flux, especially in our two states, which is why so many businesses have generally, if they can leave California, they often do leave California. And the ones that stay are the ones where there's more of a talent pool here. That, we look at Silicon Valley, right? There's a lot of the IT tech people there, but then there's a whole lot of them in Texas as well. We look at the ports here. Well, you can't get ports in Nebraska. So you cannot move your business to Nebraska if you depend on the ports. So there's all kinds of those things. So the thing is that a business owner has to balance all of that, and they can't do it all their own. They often have to hire a CEO to do the thing, because if you're the owner and you can't do it, you better hire someone that can. And then the CEO and the board of directors, they hire the CFO. They get the CTO, CIO, CEEIOU. Anyway, there's all kinds of these people. That's it. And you get all those people to help make sure that the business can stay viable and relevant, despite all of that being balanced in. So when we're talking about taking on risks, you need to know all the risks as much as you can as far as what you're looking to take on. But then if you do it and you're successful, you can be successful with maximum tax breaks because you were successful. And then unfortunately, here's what happens. We have certain presidential candidates that say you didn't build that. Right? Well, you can tell where my perspective is, like, well, we didn't have to build the roads. We didn't have to, create our own labor force. That's what farmers used to do 200 years ago, right? That's big family farms. They had big families to work on the farm, right? Well, you didn't have to do that. There's all of these other considerations. Yes, you did not have to build that, but you did have to put it all together to make something unique and different that didn't exist before. Or you bought into someone else's system, like in a franchise kind of a thing, in order to use their systems and technology and training to create something that wasn't there before. Or you got licensed and you became proficient in doing something, so you can provide services with at least your own way within the laws and such of how you work. So there's all those different things that if you're willing to do that, the tax code will reward you for doing so, as long as you do so legally within what the code allows. So that's my 1 hour rant on the tax code without giving any tax advice. We didn't have to dive deep. We were talking about the philosophy. Whichever quadrant you're in, there's advantages there. You just have to know what they are and realize that the people who that one political side says you're not paying your taxes, they're making a moral judgment and of what they believe on the outside. And but there is something called the alternative minimum tax that's taken various forms. But these companies, they're paying taxes according to the tax code, and they are under no obligation to pay any more than that, other than what the code tells them that they have to. And if they did, what kind of return is that for the shareholders? The shareholders who are investing in those companies, they want a return. They want a dividend payment. They want income. They want the return of their capital, whatever it is. They are under no obligation to pay the government any more than what the tax code requires them to.
Yeah, and the shareholders want, really, they want record profits year after year after year after year. And if you're constantly having to pay untold amounts of taxes, that's going to cut into your profits. So there's a give and take there too.
Which is why now we've got, and I won't say now, it's been around for I don't know how long, but we've got lobbyists in Washington to help lobby for the various interests of different businesses. For example, Microsoft didn't have a lobbyist until I don't know how long ago it was, when they said that they had a monopoly on everything, especially on internet browsers. Well, Google Chrome has taken over since then, but now Google Chrome is under attack. But either way, sometimes you have to have lobbyists in Washington to make sure that they can protect your best interests for your business, so that you can return back to the people that invested in that business.
Yeah, I can't remember the last time I purposefully used Internet Explorer.
I use Internet Explorer for one reason, to download Google Chrome. After I reinstall Windows. That's the reason why I use it. Even though now Microsoft Edge, because that's the new browser, it is essentially Google Chrome, but Microsoft's version. And I think it might even be a little quicker. I'm still stuck on Chrome. It works. and I customize it the way I want. But yeah, that's the way that works. And even the insurance industry, I'll say, especially the insurance industry, we've had, through at the time called NALU, National Association of Life Underwriters, now called NAFA, National Association of Insurance and Financial Advisors. We have our lobbyists to make sure that we're advocating for policy owners and insurance agents and insurance companies on the local, state, and federal level to help make sure that our business interests are at least represented in some way, shape, or form. And many times they're successful enough. Sometimes they're not, but at least we have a voice. And we always appreciate that, but we see that as being appreciative for our interests. Other people on the outside, well, the insurance industry, they're trying to protect their interests. Well, duh, everybody is, as long as we're trying to do it the right way. Of course, that's a moral decision and depends on what side the perspective one has. So I think that was pretty good.
Yeah, that pretty much takes care of it.
All right, guys. Next week, we're going to talk a little bit about business planning, just a bit, and just an introduction on the topic, and we'll go from here. Everybody, I'll catch you all next time. Take it easy. Have a great week, and see you then. Oh, hit like, share, comment, subscribe. Do the things. We appreciate you. All right, bye-bye.
You have been listening to an episode of the Financial Advocacy Podcast. As a reminder, you can't hold us accountable for any actions you take on your own. Just like all financial entertainment shows, we are not providing legal, tax, or securities investment advice of any kind. We do provide general investment information for educational purposes only, and we will discuss alternative financial strategies that do not contain accrued securities. You can view all of our disclosures and disclaimers at our website at www.financialadvocacypodcast.com. Look both ways for across the street. Thank you for listening, and make it a great day.